Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for June 22nd, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about today is just my own opinion and not a direct trade recommendation. What a wild week we are having in row crops. We're getting some volatility. Even crude oil's taking a lick today. But I generally think that get our charts up here, that some of these corrections were, long overdue. We've had, and this is true of just about any futures market, doesn't have to be the row crops, but whenever you get, parabolic and extended like moves that go on and on, it's not unheard of or uncommon to get very swift, pullbacks and volatility, right? I mean, since last Thursday, right? We've rallied over $1 in the soybeans. I mean, Novi beans started from 12.40 area. We're sitting at 13.39.50 here into the close today. That's $1 higher than where you were this time last week. That big markets, right, have big swings, and they're gonna do that. So, all right, today we're really going to be focusing on a lot on the row crops. I mean, as we kind of always do, but we're finally into the full swings of weather markets, and actually for the day, I want to begin right there because over the next week, one of the changes that's kind of happening now is that we're starting to see triple-digit temperatures make their way throughout the Midwest. And this heat that's down in Texas, I mean, I know over last weekend we saw some triple digits up here in the Dakotas. I certainly had friends sending me, 99 and 97 degree thermostat or temperature readings from Kardashians and everything. But the point being is that there are kind of two big heat domes that were in this country. The big one now is just down here in the Southwest. But it seems over the next week to just be creeping up through Oklahoma, through Arkansas, into Missouri, and into Nebraska here over the next week. And I mean, 100-degree heat here in the quad state area is just a massive change from the mid 80s and lows in the 60s and stuff that we've seen over the last several weeks, right? So if it was dry before and the heat wasn't that bad, well, now it's going to be dry and the heat is starting to rear its head. And if this heat dome makes its way up as it usually does and sits over the country, things could get interesting real quick. So just going to kind of flip through some of the normal weather charts and things I look through. Definitely some interesting, depressions and things forming in cloud cover, moving across the country, but our problem area just remains without any hope. We're starting to see the tropical depressions and the hurricane-like storms forming, right? There's a couple we've been talking about that could become hurricanes and what have you, but none of these storms are making their way to the U.S. coastline. If we go back and you look at the prevailing winds and the way weather systems are moving, we're still sweeping all of this moisture off the Gulf and off towards the Atlantic, and nothing's making its way up into the Midwest, which would be a shift in weather patterns that could change things dramatically here this year. A lot of the prevailing winds we're seeing have been pretty turbulent, and we're not seeing a lot of typical like weather systems forming from them, but this is the map I really wanted to start getting to, because you are starting to see these thunderstorms that are at least starting to bring pop-up relief across the country. And some of this rain getting added into the forecast is probably why we're starting to hit a little bit of a headwind here, certainly for soybeans, because I think at this time of the year, I think we can all agree it's a little early for a weather market for beans, but that problem area here in the Iowa, Illinois, Missouri area, it's just, we're not getting any love from Mother Nature right now. The 6 to 10 day forecasts in the GFS model, I've almost written these off as just don't even bother looking at them anymore. At least for this part of the country where we're having the problems, they have been anything but accurate. 8 to 14 days, still showing rain across the Midwest, right? Probably a reason we're not, barreling through highs again today. Is that these rain forecasts are bringing hope and uncertainty to the weather market, right? Markets like uncertainty or they don't like uncertainty, and they will trade through periods of price discovery based off of uncertainty. Temperature forecasts, which are really kind of blows my mind that in the 6 to 10 day, we have this way below and near normal in the I states. But when I look back, I mean, I don't remember 85-degree heat being below normal at this time of year. Okay, fine. That's fine. But what we're really, really worried about is this extremely above normal heat dome sitting over Texas. If that starts creeping north, and in the 8 to 14 day forecast really suggests it is. I really do not know how all that rain that's been added in, I don't know where and how that comes into the model. It just logically does not make sense to me. I'm not a climatologist. I'm not a meteorologist. But when you add 100-degree heat, you don't get rainstorm, or you don't usually get to drought conditions. You don't usually get rainstorms. So shifts in prevailing weather, though, are going to come from, this is all we're talking localized weather, right? Jet stream shift, weather pattern shift, hurricanes start punching their way into the Gulf. Things will change. But does that happen over the next 3-week window where we really need it to is the $1 million question. Maybe, billion or $1 trillion if we really get down to it. Rainfall the last week is really where I'm coming back to. Let's see. I want to show 2 maps. Here we go. This is just the straight last week, right? This map, if we take it back even further, stop moving around on me. There we go. It is just so apparent the precipitation hole that exists over Illinois, Iowa, and Missouri. And it is definitely, right, the place to watch. So since last week, or since Tuesday, which is when the drought map, our last drought map just came out, which we're going to look at here in a minute, the update to our drought map. Since last Tuesday, or this Tuesday, through today, you need to take into account that range and what's happening, because that is the unaccounted for data in the current drought map that we just looked at this morning, okay? But this week so far, right, it doesn't really show anything in that big hole that would suggest that this, drought map isn't still accurate, or for the last 3 days hasn't gotten worse, right? And that's something to consider when we look at this. It's actually, technically speaking, old data, but just by a couple days, and certainly is showing the trends that we want or don't want to see, but are tracking and need to continue to track, because I think that the second a well-poised storm does come through, this could all get very, very nasty very quickly. Okay, so let's begin with soybeans today. So weather, there is not much to sink our teeth into in terms of looking for more precipitation. We know the forecast modeling says what it does, but generally speaking, I think that we're at the point where rains, for corn at least, rain needs to prove itself rather than just the forecast. Beans were down 50 cents today. Corn was down 20 and, closing down only 8 there for December corn. And an inside day, by the way, just looks like, this looks like a market taking a pause here at the highs. Look, big move up, pause, big move up, pause. You don't go straight lines forever. And actually, this breaks the idea that corn is just, going up too far too fast, right? Today's pause, if you look at like oversold indicators in like RSI, we didn't really fall apart today, but the RSI did come off of 1.0. We're coming back down and almost back down to 0.8, which would be out of overbought conditions for corn. And that could happen just by kind of going sideways here for the next day or so. And that's, so long as you don't break all the way down and start to head down to oversold, which is an indication of like a reversal at that point, because now this selling pressure is starting to put up more progress, right, than the longs. But the idea being is that, okay, you're going to need to see that kind of stuff if we're going to continue higher. Now, we've come so far so fast. I think pullbacks towards $6 can't be ruled out. And a retest of this broken trend line is still on the table. So let's kind of go back in time for a sec. Let's, remember where we came in corn. The big run up we had through 2020 through 2022, the 50% pullback that we effectively had here, it arguably went and held the 61.8 line, but big three race back into 50 to 61.8 lines. I mean, this really looks like looks to me like a market that is going to try to go for $8 or above. Man, it's just a matter of how you get there, right? Going through the trend lines here, we're above all our moving averages. I mean, there's not much on the technical picture to paint other than, today was an inside day against yesterday's price action. I think so long as you're above the $6 figure at this point, you have the ability to flag and a pennant or create some, take a pause up here before continuing higher. But generally speaking, we're in full swing weather markets, and we're going to continue to anticipate, buying the dip until rains prove themselves for December corn. On the smaller time frame, because we did leave some open gaps below us, two of them to be precise here. Okay, that's a 15-minute chart, but I'm going to go down to 4 hour, just to start us off for a little bit here. All right, so below us on December, let me get rid of some of these fibs because we'll put those back up. All right, so below us, just call it 598 area, just below $6. We left that open gap from earlier this week. A gap that soybeans was very adamant about filling for themselves and continuing a little lower here. That corn has, really, at least December corn has stayed away. And I think, right, that is just a comment on the current weather market for corn versus soybeans, right? It's full blown for corn. We still have hope for soybeans. The open gap at $6, though, is certainly a short-term level that at this point you really don't want to see the market come back down to. But if it did, I would not. It could be a gap support. And I'll get to why there's some other levels there to make you think about that, including the original gap up that we had on Monday, right? We basically gapped above 690 or 597 and above 6, ran back down below it, and then, the following day gapped up. I don't even know what I would call this thing, but it's like an untouched day. Like it has a day that has, the opening and closes, right? Aren't touching, right? There's literal gaps on both sides of the market there. So clearly $6 to somebody, there's a wrestling match here over that figure. Resistance on the way up, support now on the way, on our way back down in a subsequent turn. Open gap down around 531.5, right? The one that began this whole run up. Now that's the breakaway gap. That's the breakaway gap. So technically speaking, getting rid of a few of these trend lines because they won't be relevant for a while now. Full 50% retracements off the lows. We were tracking here the 532.36 area. Had pulled back to 513. They went up to their targets. Market held, another full 50% long from swing low to high again. I was, nevertheless, 548 highs down to 519 lows. Ran up to the first targets here. Tried to pull back, but really just blew through targets, right? So now from highs to highs, I start drawing up, my bigger continuation swing. If it wants to have it. And you know what, there may be more aggressive levels now because of some of these other little highs. But the point being is that if the market is going to pull back, right, in just an intermediary pullback, the 20 to 30% pullbacks, not the full 50s, it will do so, probably into that $6 figure, 590 being where that support area is before heading higher towards the 650 upside target. Full 50% swings here. You can see at the 560 area. Yeah, I'd be a buyer down there if it went there. It's a long way off, but that'd be a retest of this broken trendline resistance. So I don't know. Maybe I'm just painting a picture here with my words. Maybe we see some weather come through, some rain. I don't know, maybe a forecast really starts to show, high probabilities of rain. I don't know. You get some event that knocks corn off of its rocker here for a few days. I mean, heck, just profit taking alone, if we start to slip below 6, might take you lower. But the point is that if we do slip lower, right, there's a big technical level at 560 that I would not be opposed to being a buyer if it get down there. Now, I do think that that is a long way off in this current environment, and going there quickly would need, a justifiable event like weather or something to justify it. And then, of course, the subsequent holding of that level and rally would probably be because the rains didn't come or people shrug it off. But in the meantime, there's a much more aggressive trend line support now and almost channel coming through this market that is going to be at 6. Multiple fibs that we can draw, extension fibs, so highs to highs, right? They're aggressive levels that if we pull back towards 6, I think would be supportive. And so long as we're generally above the lows from that very weird day, the non-touched day at 588, a bullish December corn continuing higher in the trend that we're currently in, right? And that's assuming that today's inside day does continue higher out of here, because we go lower and you break through this channel that we're in. We go down, below the lows of today. There's a pretty good, easy 10-cent slide down to $6. Below there, we're talking retracing a lot more. So going down to a 15-minute chart intraday here, very much a bull flag, but I think the market having gapped down, and beans did this too, off of finishing at highs. I mean, I wish they would have told us all that you just needed to sell yesterday's close, and that was the trade for the day. But 50% pullback basically from the 604 lows of the week to the highs after. Trades, holds, and a swing to the upside to new highs to 635, as long as you're above, the lows of today at 613 seem to be a potential, direction or move this market could make. So now it's fun that we get to now track the trend higher because we actually have some, price action and things to look at. All right, so corn, generally speaking, I'm not too worried. I think you got to still think about, wanting to buy the dips and what have you. But it's a tough market, and it's been a very, very volatile one. Soybeans. While equally impressive of a rally, are only just starting to get back up to levels that we had really collapsed from. July beans today closing 34 cents off of their lows. An incredibly impressive rally. But it's still a lower low and a lower high for the day. So we will see if things fade off and what have you. It could get ugly again, but so far I think support has proven itself in the near term, right? And you have a low of the day to watch that, hey, if we go below that area, we really are carving out a potential top. August beans pushed above their 200-day moving average. That quick sell-off here, the de-sell-off in the morning and into the lows of the day, tested the 100-day moving average, and then we got back above that 200-day by the close. That's a pretty good technical kind of reestablishment of back above these levels, which again, we fall back below 14 now in the August beans. You fall back below that 18-day move or that 100-day moving average. It's a long way down to the 55-day at 1342, and an even longer way down to 1308 at that 18-day moving average, right? Because we've come up very quickly. Little sideways price action at highs is not totally unexpected, but hopefully we don't see that just V-shaped sell-off. That, not saying it will occur, but could occur from levels like old trend lines against the highs, right? And if you look at November beans, we'll look at this level's also pretty prevalent. That clearly we're back up in some kind of Well, we're back up into the old range for soybeans. Novi soybeans, very similar to the August contract here, only they broke above their 100-day the other day, and we only pulled back to test that 200-day moving average today. This old box that's on the chart at 1340 to 1320, that was the supportive range from August of 22 through April of 22. And we broke through it at the start of April, went down to the lows of 1250, came all the way back up to test that 1340 area again as resistance, and the next 2 months were, history, collapsing down to 1130, lows. Market found support, found buyers, crossed back above the 18-day and the 10-day moving average, got back to the 55-day moving average, got back to the 100-day, and now we're breaking above that 200-day and into the range that we were in from July through April of this year. Really, we're right back to where we were. It's almost like March through April just never happened right now. I would like to see November beans push to a new high for the year, like we've seen other contracts. That would also, I think, help the case for, the bullish case for beans right now. But I'm also concerned about this trend line against the highs, which, okay, if you draw it exactly on the points, it's a little higher than $14. But I think the $14 figure now for Novi beans on the way back up is going to be considerable resistance. Will we go through it? Possibly, yeah. There's going to be a lot of people who probably sell 14 just because it's 14. And that's a terrible reason to sell 14. Now, if you're getting sales done, that's a different story. But like from a speculative standpoint, just buying and selling round numbers, it's kind of a weird, it's not, does it work? It could. I guess it could work as good as any other indicator, but generally speaking, it's pretty arbitrary, right? But there is something psychological about it. And it aligning with this trend line and everything else, it just, to me, seems like there's probably a ceiling on beans here unless things get dramatically worse, right? And we're not at the dramatically worse yet for soybeans. Parts of the country for corn, we are. There's a reason that weather market's going on. But I think the selling pressure we saw today was more a reaction to yesterday's move in the bean oil. A limit down move after a gap lower on an EPA announcement that in biofuel mandate, in the biofuel mandate, the EPA announced that there are plenty of effectively that there are plenty of other sources of oil for diesel. Whether it's animal fats or fibers from cellulose plants, they added in mandates for the use of those products and reduced the mandates for soybeans. So, obviously, that dropped the price of soybean oil and the demand for soybean oil. At the same time, right, soybeans was actually rallying. Yesterday, soybeans finished the day at their highs, with bean oil finishing at their lows and at a limit down move. The crush spread was absolutely obliterated, right? In 1 day's time, you had one of the biggest swings in the crush spread that you've had in weeks to the downside. And so economically speaking, right, I think that was unsustainable, right? And there's a reason I think, okay, bean oil went down a little bit here today, I think with the whole bean complex. But then look, we finished positive on the day in the bean oil. And on a pullback to the 18-day and 55-day moving average, I don't know, this looks, and was that close back above the 100-day here at 53? I mean, it was really close, but this really looks interesting. Like, was this a 50% pullback into that support? I mean, we unwound any overbought condition now. So if bean oil goes back to 60 or something, what does that mean for soybeans, right? It gives soybeans that room to the upside that they didn't have before because bean oil sold off, because crush margins go down. And if crush margins are down, no one's going to buy beans to crush them because it's not profitable. So, or it's less profitable. And if you're, not inclined to push your production, you won't buy the beans that you didn't need to, right? Or wanted. All right. So bean oil sells off. Today, soybeans need to rebalance the trade in the crush spread. I think that's happened. So let's look at the short-term levels on Novi beans that I think were kind of the tell today that I think a support just traded. We could retest these levels. You could go a little bit below, but generally speaking, I think since our very big dollar plus run up, and remember, we were actually like making those highs right after the bell here on Friday. Okay. Then we pulled back from like 1347 down to 1325 or whatever it was. Went up and settled at 1342. 1342, we gap up the next day on Tuesday night. We then sell off back down to that old support right into 1324. We rally back to close the day at 1342.43. And actually a green day. We actually closed up a penny, I believe. We gap up, we sell off, we close the gap, hold the gap as gap fill, we push up to the new highs. Oh boy, we're breaking out. And we just gap down and run down. Because again, we closed here at highs in soybeans and at lows in bean oil. Beans had to come down, oil had to come up. Like, the crush just had to realign. And it did. But sell off all the way back down to that 1322, 1324 low. And actually go just below it to hunt stops. Oh, that's one of the dirtiest moves I've seen in a long time in soybeans. Because believe you me, all of this price action gave us plenty of reason to think there was some support and resistance, some support on the way back down here. Nevertheless, the 3 days worth of lows, the support is holding. And so I'm bullish above, bearish below on Novi Beans, 1322, lows of today. Maybe 1320, just make it around 1320. But from here, upside targets could take you to 1401. Should take us up to 14, I believe. And if we look at where, some upward sloping trend lines have been, I feel like it. We'll see it better here. There we go. Meant trend channel. So a little bit of a trend channel here on the beans as well. 4-hour chart, Novi Beans. Take the highs, drop the channel down to the supportive low, and bam, 1324 yet again. So we'll see what happens here. I think if we had closed back into yesterday's range and above, 1341, I would have been a little bit more inclined to say that all this price action was just a stop, hunt, and done. But yeah, I'm fearful that we rallied back up here. If we kind of roll back over and head lower, well, you're going right through this channel / trend line support. You're breaking this other fib, and I think we're falling now at that point to really down to 1287. And I mean, what would stop you from, why not back to 1250 from whence you came? I mean, it took 2 days to go through those levels. It could take a day or two to come back down. Not that I would wish this or want this, but that would also be a test of the broken, trend line resistance, now a support, and a test of our original trend line support off the lows. You can see where those two come to an apex together or cross over, and it's right around and somewhere in this 1351. If there's an idea of a pullback to there. Okay. So, Novi Beans. August beans, very similar levels there, $13 or $14 or the 1324, but markets kind of spoke. All right, wheat markets, Chicago wheat. Finally, getting back to being able to talk about a test of the 200-day moving average there. That's something we haven't been able to utter this entire year. And actually really going back to October of last year. So Chicago wheat in the July contract finally back to, or getting there, right? 758 would be the 200-day moving average. We blew through the 100-day there a couple days ago at 687. 10-day moved over to the 18-day. There was a declining wedge that we've been talking about, and this, just kind of waiting and wanting trend line to break out. And finally, that's happened. It's interesting that the breakouts in, both corn, wheat, and beans. Well, corn not so much. Corn actually, I think, gave you lots of opportunities. Down at while they were kind of building into their current rally to get in if you wanted. Beans and wheat really have not given traders much opportunity here. These moves off their lows, and today's low included for soybeans, have been really one directional and not easily traded, which makes it hard to position or to do anything but just cover shorts if that's I guess what you're doing. But okay, so Chicago wheat is now starting to get up to that 775, 770 area. It's old support, you could say. Where's let's get a rectangle up on this chart real quick, so you can kind of see the supportive area that I'm talking about here. Right, from 808 down to 770. It was also then resistance here on the way back up. Once we went through it, resistance, and now we're coming back up to a test of that area, back above that 200-day, back above $8. That's where you could, I think, really start talking about the daily and the weekly trend having shifted. For right now, yeah, definitely there's a trend higher, but when you take a big step back and you look at the highs of wheat from 2022 to how low it got, you have to consider that there's still a downtrend intact in some capacity, whether it's the bigger on the bigger picture. Okay, not saying you have to trade it or believe in it, but respect the fact that this market is rallying up into levels that could be resistance. Right, they were support at one time, they were proven resistance before. It could be it again. So hey, if you're long wheat, not a bad area for targets or to think about taking gains or something with that capacity, right? But we'll see how that comes to fruition. Kansas City wheat here today and the spring wheat closing down. Actually, not a good look. And a little bit of a different looking chart still than the Chicago wheat. Even though, right, I kind of favor spring in KC wheat, the Chicago wheat seems to be getting all the love of this short covering rally. We are back above the 200-day moving average. For all intents and purposes, yesterday was a break above. Today was a follow through of, and then a pullback to test that 862 area for the 200-day moving average. We really need to see KC wheat tomorrow and tonight start this off strong and retrace this long wick. And get above $8.90 into $9. If it can't do that, I'm afraid we're finding, old. We don't need this fib up here anymore. It's just to show us the range, the old range highs. Right, there's clearly resistance 880 or 878, through 923 in this chart. 1, 2, 3, 4, and now a fifth time. And that's not counting all the minor tops. Like here was 4 days worth of highs. Here's 2. Here's 3. Here's 2. Here's another one. So you've got a total of almost 10 days of trying at these levels to break out, and it just doesn't. So let's call this what it is. It's a range until it's not. Okay, above $9, I'll get super bullish again. But I'm very cautiously optimistic right now that we will break through those levels. And if we don't, we could very well roll right back over. And, the middle of this range at 833, which is 40 cents below us, seems like a highly probable, place that would trade again, that it's going to be tough. So that long wick, I don't like it. We're overbought in the daily RSI, unwinding it and seeing a pullback down to our other moving averages. So, whatever, it could happen. But generally speaking, if we fall back over, there's not much in this range. It's been sideways until it's not. So we'll see what happens with that. But on the short, time frame, the short time frame, I think it's just these dailies that you really need to watch on the wheat. But anyway, very aggressive trend line support for Chicago wheat. And arguably, if we want to start drawing up potential channel, you take this high here at 648, draw it through our current high, and that high might get higher. But drop it down to the supportive area, whether it was the lowest low there or this one. I think you can make a case that if wheat had a pullback, right, $7 at this point is probably an interesting level. That's also the highs to highs extension from 647 up to highs. That's that 50% fib you see here on the chart at 697. And that would also be a gap fill for Chicago wheat. So would not be so disappointed to see it trade down there. And maybe even think about being a buyer, as there's, again, now multiple levels that Chicago wheat is breaking above, trend lines, what have you. It would also be kind of this old inflection zone that is on the chart as well. So still in an uptrend, still higher highs and higher lows. Going to be important to watch KC wheat take out that wick to basically tonight, or it might just not happen. Live cattle, not a huge mover the last few days. Things have gotten actually a little quiet, but October fats are starting to kind of creep back up. It looks kind of like a bull pennant that tested below the 18-day moving average and is trying to get back above it. And if it does, I don't know, cattle might be a little bit of a bull flag, and it might have a breakout set up into tomorrow if it kind of moves higher, breaks above 76, and comes out of this oversold condition. I think you could make a strong case for, another high, and, whether or not that's the tippity top or not is another story, but at least price action in the last couple days has really, started to, I don't know. It's signaling to me that this market isn't just rolling over, right, and collapsing. It's almost like methodically trading down into support. If we found that support around, 172, I've got no reason why it couldn't be there. But I am in the camp that would much rather see a bigger dip down to 170 and what have you, with for potential better buyers or a lower price point. Feeders. The September's actually finished up the day 3 points. Generally speaking, this same idea still kind of holds here of this, I don't know if I call it a trend channel, but expanding nature of that channel because of the expanding nature of that channel. But we did get the 18-day, 10-day moving below the 18-day cross just a couple days ago into, well, actually that all happened from our open this week, but pulled back effectively to the 230 area, tested that 100-day moving average, testing our old highs, right, that we broke out of. And now with 2 open gaps, really count that 1 open gap from today above. We head back. I don't think you should rule out a move back to test in the feeders towards the 18-day moving average above as now resistance. And if it does hold as resistance and we roll back over, there's a good case that there's some trend line here that below today's low, gets ugly, and you really start reversing what is otherwise a large uptrend. We are oversold, so I'm kind of anticipating that move. Back to sorry about that. Not missing much on these cattle charts though. Move back to the 18-day moving average and just typical retracement, right? And if that's the case, what are fats going to do? Are they going to go push highs? Feeders and fats have had some, some. I don't want to say they're breaking correlations because they're not, but feeders were definitely leading to the downside a little bit here, and fats today, and certainly the reversal in feeders helps, but fats today, I think, kind of put a foot in with their low of the month, but we shall see. Crude oil, massive collapse in crude oil today, on the back of EIA announcement, which at face value actually looks pretty good. It looked like a draw, and then when you read into the revisions, it looks like that there were actually builds and even more releases from the SPR, which you got to ask yourselves, why do we even bother releasing numbers that you go back and revise? I don't understand how that is scientific, mathematical, or statistical at all. But hey, I'm not government people doing government work, so I guess it's just a higher standard that the rest of us hold ourselves to, but we just let all these institutions get away with. And the USDA is the same way, right? We see this in heck, the Labor Department with the jobs number every month. I mean, it's becoming a joke to me, but What can you do? And the last year, anyway, that's a discussion for another day. Crude oil, though, still very much stuck in this range. Can't bust out above 72. Can't, it spends time below 70, but you can see here it's not very long when it does, a day and a half, and then it's right back up and short covering to the high end of the range. I can't trade an asset that is being geopolitically battered around like this between, massive governments, right? I don't think anybody does well trading futures like that. However, that doesn't mean there aren't opportunities here. I think that certain option strategies could be viable, but for right now, until you get back above 76 and certainly above the highs of the month at 73, 74, there isn't much to do, in my opinion. Likewise, until you get below the lows of the month, around 66, there isn't much to do. If you're a range trader, you should be in heaven. But being a trend trader and here and the way we talk about the markets, this is not conducive to trade. And there's a big reason why crude pretty much this whole time, from at least February, we've been talking about these areas that we need to see the market to overtake to really start hopping in and think that an actual trend higher can begin, because this is not a trend higher beginning. If anything, it's still being forcefully sold down is how this feels. It's just like every rally gets forcefully sold down. And there aren't many, when we get forced down, there aren't many panic sellers. Like, we're not busting through levels and hitting stops and absolutely, deteriorating. And, I would love to be a fly on the wall and understand more of the actual decision process of how this is getting traded by various, institutions like our government, for example. Are they trading the range effectively? Are we seeing sales when we get above 70 and then they're buying when we break below? I don't know. But what I do know is that from April of 2020 through the current high in March of 2022, we've basically pulled into a 50% retracement. We are testing, this old supportive area in 2021 that was the baseline at 60, that every rally, serious rally, including the one in November that ended in, at the highs with the start of the Ukrainian-Russian conflict and the war in Russia, or in the Ukraine with Russia, that marked a short-term top or a top, and we pulled back. This looks very much like a market that's taken 2 steps forward, 1 step back. And I think right now the biggest question for crude, outside of OPEC production and U.S. releasing oil reserves and all that, the biggest question is what's the future for inflation right now, and particularly inflation in the energy market? Because I think you got to think about inflation, and I think we should start thinking about inflation in different asset classes a little differently, because it seems to behave differently in different assets. And certainly it behaves differently when there are, supply chain concerns or issues, right? And certain commodities and things are less affected by those types of ideas, right? Crude is kind of one of them. Crude proverbially flows like water. And in a country like the United States, it's not really an issue of supply ever, nor has it really ever been. Well, I can't speak to the 70s, but at least in the last 10 years, in this push to become energy independent, supply is not the issue that gets people panicking. So you have to wonder, what's the where's the consumer demand? Did gasoline prices, are they rationing that demand at all? I know since 2020 we haven't seen that big drop, and even at that peak, I think there was at most 10% reduction in gas demand. That's certainly gone away with where prices have gone. But if you notice, even in this swift decline in the price of oil, gasoline prices never seem to really come down. So it seems to me that there is a lot of room, and I'm not tracking the crack spread here, but it seems to me that there's probably room in margins, for prices of oil to come up, given what consumer demand has proven they're willing to pay. So I hope that, we start refilling that strategic oil reserve. We're down to the levels that our government has told us they would do it at, but we continue to see revisions and proof that they are actually releasing oil, and that's, that's not going to be conducive to a rally here until that, I think, trend reverses. If arguably that is the whole reason oil is down. And the last but not least here, you got to consider, the nature of, are we heading into a recession or not? You look at the stock market, look at the price of oil. I don't think we are. Oil prices below 60 are recessionary to me. Oil prices above 60 are expansionary to me. They allow countries like other countries to actually build new oil wells, right? You don't get that below $60 a barrel. And hey, that's just expansion in the oil world, but that means companies making money. That means more jobs. That means, oil sands that aren't profitable at certain levels are, right? So people are working, making money. S&P 500 has had a couple days of a pullback. We're going to close the session here today, taking a look at this because I think we've pushed now up into levels that have proven to me that, we're out of whatever pullback and recession-like move on the charts was happening, right? I'm not talking about economic recession. I just mean, hey, the S&P 500 fell from 4,800 down to 3,500. That is a big enough drop to consider a recession having happened on a chart, right? It was a 50% pullback from the 2,200 lows of COVID to the highs of, to that all-time high. That's a substantial move that a lot of people wanted to see this thing go even lower. But that's the new normal I think we formed in the stock market. And by the way, that new normal was above the all-time highs before, Black Monday in COVID, the COVID Black Monday. So needless to say, markets pushed up above trendline resistances. It's holding what looks like a pretty good channel up. And, we left a gap open on the continuous chart of the S&P here at, 4,300. It's probably going to come down to 4,300, right? I think now that we've broken out of this highly visible resistance that over the last year, everyone's been arguing over at 4,200 to 4,300, now it's time for the market to probably pull back into that area. And I wouldn't be surprised if that, continues here with the Fed continuing with their idea of pausing their interest rate cycle here. Or I'm sorry, not pausing, but, having paused and then now, raising rates again, right? Getting back to it, unpausing the interest rate cycle. So that'll cause, I think, into the next, report or so, some fear in the market will come down and people, oh no, the Fed's raising rates again. It's all bearish, super bearish. Goodbye, good fight, good night, right? But the reality is the stock market can rally in a bullish interest rate environment. It has before, it will again. The real question is the amount of liquidity in the system, right? There is still so much liquidity out there that I don't believe a 7% interest rate is enough to absorb it. We are, for the first time in my life, my whole life, I'm 36 years old. This is the first time I, as an adult, have been able to go to a bank and actually get yield on a savings, whether it's a CD or whatever else. And I don't mean like a measly 1%. I mean, hey, 5% actual returns that compete with, with fund managers. Not all of them, but generally speaking, the goal is 7 to 8%, right? Well, if you're getting 5% for doing nothing but sticking your money in a treasury or security of that nature, I mean, that's like unheard of security in my world. And so the point is that my generation and consumers and a lot of people, even arguably a lot of my parents, friends and family, aren't used to that environment again, right? And so how high, and by the way, we're really used to chasing yield and alpha in the market, right? In the stock market, or beta, I guess you'd call it. So risk appetite has had 20 years and formulated, certainly in my young adult life, a risk appetite for making money in the markets and having to, make money chasing markets effectively, being invested in, a stock portfolio or whatever. That was the way you earned yield. Now we just have the first inkling of being able to earn yield through other products. It's going to take time for people to shift their idea over, especially when they're used to making 10, 20, 30% in the stock market. 5% in a bond doesn't look super attractive yet, right? Even though it should. Like, it should look like the greatest gift we've seen in a long time, right? But it's going to take a while. And that's where I believe that, there's just too much money in the system. The M2 supply and the velocity of it is just too great for, one quick interest rate cycle to really stop. Because this is, in my opinion, 30 years of effectively pent up growth that hasn't, really has. I mean, I don't know how to describe it. It's like, from 2012 through now, there wasn't really much inflation. There was some shrinkflation and some other stuff, but generally speaking, we've been waiting for it to finally come, and now the big boom has happened. Generally speaking, all prices across the board are 20 to 30% higher, settling 20 to 30% higher than where they were from their 5-year averages. And if that's the case, then 5% yields don't look attractive at all if everything's still up 20, 30%. And I honestly think we'll get to about an 11% interest rate before we see that 2% target hit by the Fed. We'll see. That's just my thrown dart set aboard, and we'll be going a lot more into that, deeper into that idea in another video. But, the trend is still up for the S&P until it's not. I think that there will be a pullback here, like I mentioned, and in the near term here, give you my quick bullish above, bearish below line in the sand that we kind of came into here today, right, is actually kind of down towards this gap fill, but as long as we're holding above 1440 in the near term, I think 45.28 is the next upside target. As long as you're above, 43.70 here, looks like the trend, will continue higher, but we roll over, which I kind of think we're gonna, just my gut says that we've had a good run up and we need a bigger pullback. And that bigger pullback, I believe, will be down into this 4,200 area. There was a 50% retreat, long effectively off the 3,500 low to 4,200 high. It pulled back into 38.50. Market rallied up to its 43.85 target. Next in the series would be from that 38 low up to the 44.90 highs, or that 4,500 figure, and that would be a pullback towards 41.62. And that would hit all of our old trend line, some old trend line resistance, now a support. It would retest of our old broken out highs. So we'll see what happens. Well, thanks for joining me, everybody. This has been your Strategy of the Week update for June 22nd, 2023. Definitely be doing another video tomorrow. Won't be the full-on webinar, but given how row craps have behaved, I think we are going to want to see how that continues. You can always get in touch with me over at Zaner at 312-277-0110. Find me on Twitter at Daniel Hussey Jr. Shoot me an email at dhussey@zaner.com. And be sure to sign up in our in the comments section here. Get our daily newsletter or the webinar from our team here. But with all that being said, everybody have a great day, have a better weekend, and we'll be back with you all as price action develops. Take care.